how do you create wealth, get into real estate and commercial income generating properties earlier than you would otherwise, even if it's a lesser amount.
The sooner you start, the sooner you're going to actually reap any kind of reward. Welcome back to Marketing Made Iconic. Today's guest is Angelo Del Borrello, founder and director at Acure Asset Management, a private real estate investment firm managing a portfolio of commercial properties across Australia. Angelo's experience is vast. I'm excited about this one, from starting his career in stockbroking and private wealth to launching a $1.4 billion listed property group to now running Acure's boutique wholesale syndicates. He's navigated every kind of market condition and he's here to share what he's learned. We'll explore what it really means to build wealth through commercial real estate, why income generating properties are king, and how to think long term in a world that chases quick wins. This is a really rare opportunity to hear directly from someone who's weathered cycles, built billion-dollar portfolios, and is still deeply curious about the game. Let's get into it. Angelo, your experience spans financial advising, stockbroking, listed real estate, and now boutique syndicates. Let's start at the top with your journey and what's changed most over the decades. What drew you into real estate after a career in equities?
Yeah, look, I think I probably got sick of losing money in equities. It's a hard industry to pick winners. It tends to be more of a short-term thinker's mindset. And I think historically, being with Italian descent, we've always had a background in real estate. So I suppose I felt more comfortable seeing, touching, collecting rent, more so, and controlling your destiny more so than, say, equities, where it's difficult to control your own destiny.
And tell us about your experience scaling Aspen Group from nothing to $1.4 billion in assets. What was that like?
Yeah, look, that was a quite a exciting journey. It started in 2002. We bought our first asset, and then we took over a suspended listed company that came out of the dot-com crash in the early 2000s, and we took it into real estate, and between 2002 to 2010, we did scale it to 1.4 billion of real estate. About 68 acquisitions at that point across all sectors. So we had caravan parks, we had office, we had industrial, we had retail. We also had quite an extensive development pipeline of commercial real estate and land development for residential. And I suppose a lot of lessons were learnt through that journey. Certain things, the GFC hit in 2008, so we certainly, as I left Aspen Group in 2010 and started Acure in 2012, we took the learnings from what we did well in those days to what we didn't do so well, and where the risks were, and took it into Acure. And namely, we probably eliminated the development side, because when the GFC hit, that was a very difficult period for any development projects. What shone out through that period was the income producing properties were really unscathed through the whole journey. So that's what we now focus on under Acure Asset Management.
And so what lessons from the GFC shaped how you now approach real estate through Acure?
Yeah, certainly, income generating is what I've learned through that GFC period is king. In a way, what we've seen over the last few days in the equity market, you're almost seeing again. I mean, the income generation in commercial real estate doesn't change. And the volatility in values, etc., doesn't change much either if your income doesn't change. So I feel pretty good about being in income generating properties today, but we've now been going near on 13 years, and there hasn't been too many missteps along the way.
That's awesome. So clearly, Acure isn't your typical property firm. You focusing exclusively on income producing assets, but across a number of different areas: office, industrial, retail, hospitality, delivering yield while also riding cycles widely. So
Yeah.
let's unpack that strategy a bit more. Can you explain how your syndication model works and
Yeah.
what defines a wholesale investor?
Yeah, sure. So we've put together 18 syndicates over the last 13 years and about 22 properties. Typically, a syndicate consists of one asset,
Hmm.
and then we raise the capital. We then manage those assets. We close that syndicate for a 5 to 7 year period, and we collect income, I always say, whilst we're waiting for capital growth to emerge. And
Yeah,
typically that gets driven by growing your income stream through your rental.
yeah,
So, and at times, interest rates will have an impact, as interest rates drop. Typically, your values of commercial property and income becomes more valuable. So it tends to go up. So, we do market our product to wholesale investors only, which is a legal definition provided by the government, and which ultimately means our investors must have one of three things. They either invest $500,000 into an investment, and they're automatically classed as wholesale.
yeah.
They either, if they're in the workforce, have to earn 250,000 or more for 2 years in a row to also qualify, and or they've got to have 2.5 million of net assets. And
Right.
typically, if someone invests less than $500,000 in our syndicate, their accountant we will require their accountant to sign off a wholesale certificate to confirm that investor is a wholesale investor.
Yeah, cool. And what types of commercial properties are you focusing on right now and why?
Yeah, look, over the journey, we do like looking across all sectors because, you know, being in the property industry for the last 27 years, I mean, we've seen cycles come and go.
Yeah.
History tends to repeat itself with property. So, today we're looking for value in office because it's a bit of a counter-cyclical. The word counter-cyclical comes into our journey quite a lot.
Yeah.
Um, it's a it's a little bit, people aren't looking at office so much with the work from home factor in some
Mm.
markets. So we're trying to identify stronger markets with office values. Um, we're also looking at hospitality coming out of the GFC where hospitality struggled.
Yeah.
Last year we did buy 4 hospitality assets, accommodation hotels primarily, with some food and beverage. You know, the journey's also, when I look back in 2013, 2015, we bought 4 industrial properties,
Yeah.
which all bar all bar one of those, we almost doubled our capital. So we've been selling industrial into a strong industrial market. And typically we try to buy well when things are out of favour and then look to sell when they are back in favour. So that in theory is what we're trying to achieve.
Yeah.
And it typically involves a whole period of between, normally 5 to 7 years, you'll see a cycle change. So uh, through that journey, we're trying to also buy assets that can deliver a 7, 8, 9% income stream along the way. So
Okay.
people get paid while they wait for capital growth, if you like.
Yeah,
That's
for
the
sure.
theory, what we're trying to achieve.
Yeah. And what key numbers or benchmarks are you looking for in a new asset?
Typically, 7, 8, 9% net income to the investor after
Yeah.
costs. So, we do
Okay.
charge fees to manage assets. There's also other fees such as stamp duty, etc., that come into play. So with real estate, trying to turn a strong return in 12 months is not easy because if you got upfront costs to acquire assets.
Yeah.
So typically you need to wait that journey out, and it is a bit more of a longer term strategy. And I suppose when I look back on my equity days, it's the tortoise versus the hare. Uh, apparently what I read in that story was the tortoise end up winning. So hopefully, property, property investors end up winning along the
Slow and
journey.
steady.
Style City wins the race. Yeah, that's one thing I've learned over a long period of time is not being a rush. Yeah.
Yeah, yeah. Has it changed? Like, is it that 5 to 7 year period? Has that been the case across the last 30 years? Is roughly the same, or has
It's
it
roughly,
changed?
yeah, I think it's a generic time frame
Yeah,
that you have seen changes. Mind you, we've still got assets that we've owned over 10 years. And not
yeah.
because we haven't had the opportunity to sell them, it's because they're performing so well and our investors are too happy to let that go.
Mm,
So we don't necessarily always sell in that time period, but if the opportunity is there where there's a strong capital gain, and
mm,
or if the income has grown significantly, you know, they're very hard to replace that type of asset. So you would try to hang on to
yeah,
those as long as you can.
yeah. Oh, you've as a perfect segue into our next section around timing. Saying timing is really important. You've obviously developed a really clear thesis around buying when others are potentially fearful and holding for that upswing. Let's talk a bit more about market cycles, patience, and positioning. And I know you mentioned you've recently started acquiring hotels again. I think actually since we experienced COVID. So, what made it the right time for you?
Yeah, certainly we started buying hotels in 2000, the beginning of 2023. Um,
Yeah.
so, which was just straight out of COVID. And at that
Mm,
point, there weren't a lot of buyers of hotels. There were still owners that were just coming out of a pretty dark patch where
mm,
some of them were closed, some of them never had the ability to generate income. So we managed to buy three assets in that year at a pretty good price. Right, range sort of returns we look for in the hotel sector. We bought the Siebel Hotel in Mandurah, West Australia for at an 8.8% income at the time. We look at a
yeah.
couple of things in hotels. One is the replacement value.
Yeah.
What are we paying per hotel room or key, as we call it?
Hmm.
In that particular case, it was extremely well below replacement cost and, generating 8.8%. Now, today, 2 years on, that assets, but last year generated 10.5% on our investment. So
Excellent.
that's heading in the right direction. And
Yeah.
because we have picked those three up at a good time, I must say it's getting a little bit harder because things have moved on a bit now in 2025 at hotels. Harder to
Hmm.
find the value that we saw 2 years ago. So
All
yeah,
right.
that led us to buying an office building recently in the Gold Coast. And so we'll look at a different sector. If the value's gone out of that sector for the time being, we'll progress to another sector where we do see value.
Yeah, right. And what I think you're talking about now is that sector rotation piece, which is because you've got such, I guess, a diverse portfolio across sectors, that is a way of future proofing, if you like. But what else do you consider around that sector rotation piece for your portfolio?
Yeah, look, we do like to have a bit of exposure to different sectors and in also different geographies of Australia because you do see various geographies being stronger at certain points.
Mm.
And obviously that applies to the sector as well. So, at the moment we're looking for another opportunity for our investor base, and we're looking across office, we're looking across retail, we're looking across hotels still if something was to
Yeah.
come up. And we're also got a bit of an eye to industrial as things have softened a little bit from when we sold a couple of years ago. So,
Mm.
we'll look across those four sectors to see where we can uncover a gem, I suppose. And,
Yeah.
we don't buy a lot. We might buy three, 4 assets a year.
Yeah.
Um, and we might look at 100 properties before we make those acquisition decisions. So
Yeah, for sure.
it's a long journey, but it's also fun, trying to uncover these opportunities.
Yeah. And where do you think of the particular um, opportunities exist for 2025?
Look, we geographically wise, we like
Yeah.
Queensland because of, I think, the Olympics story coming up.
Yeah.
7 years away.
Yeah.
If you look back on the Sydney Olympics quite some time ago now,
Mm.
there was quite a strong up in real estate values leading into the Olympics.
Yeah, right.
So, we have got a bit of a thesis that if we can buy value in Queensland now, we'd probably start to look to offload prior to the Olympics.
Yeah.
Um,
Nice.
Melbourne, we're watching closely. There's been a lot of government um, changes in property taxes there, which
Yeah.
is affecting existing owners. So we are looking closely at that, and at some point there'll be some value there um, because of those changes. But
Yeah.
we are going to be taking a pretty long-term view of Melbourne. It's still got a big population.
Yeah.
You just got to buy better than what we could have a year or two ago before they changed the settings. So
Mm.
that's what we're waiting to see whether that gets unearthed, because I'm sure there'll be a lot of people exiting Melbourne who have been there a while and are a bit annoyed with the government property taxes that have been implemented.
Mm.
And we've
You
seen
meant,
we've
yeah.
seen examples there where foreign investors in particular,
Yeah.
are paying. I saw one office building recently that they were paying in excess of $1 million more land tax because they were based outside of Australia than say
Wow.
an Aussie. So there are those type of things that create decisions for investors to sell, and for us, maybe an advantage to buy.
Yeah, right. You mentioned before your experience, if I can say it this way, your experience has been the best teacher, especially when it costs you money at the beginning.
Yes,
And I know
yes,
you also have strong views on newer asset classes like crypto. So let's talk real estate versus everything else.
yes,
What do you wish you knew when you were just starting to invest?
yeah. Well, look, like most people start off, and I was one of those. We don't start off with a lot of money in the early days. So,
Yeah.
as a young person, you get caught up in trying to make quick money, and
Yeah.
along that journey, you might have a couple of wins and you might have a few losses. My experience was we had more losses than wins in the early days, particularly in equities. So, which made my change pretty easy to go into real estate. Luckily, I bought some
Yeah.
real estate at a young age, and I saw that journey evolve and grow a lot more securely. So, I think if I was, you know, advising someone who was in their 30s, how do you create wealth? Get into real estate and commercial income generating properties earlier than you would otherwise, even if it's a lesser amount, because
Yep.
over the journey, it sort of accumulates quite quickly if you've
Yeah.
got that income coming through each time.
Yeah, that's great. The sooner you start, the sooner you're going to actually reap any kind of reward.
Yes, it is a long-term game, and hopefully most of us are around longer term,
Yeah.
uh, you know, and we have a certain work life to make it worth everyone's while.
Yeah, totally. So, why do you prefer real estate over more speculative assets like crypto?
Yeah, well, crypto is an interesting one. I mean, I've got young kids in the 20s, and they're educating me on crypto. Um,
Mm,
there are some out there that say it's a legitimate asset class. I see it as a number on a computer screen. I don't see what backs it. At least
yeah.
with real estate, you can touch it, you can see it's built, you can see that there's a replacement value. Equities, okay, you're buying businesses. You need to understand those businesses. Crypto, I'm
Mm,
still don't quite understand what sits behind it, other than people who are speculating, maybe people who are trying to hide money that's been
mm,
made illegitimately. It's not a bad place to park money for that purpose. So I'm not quite sure if it's an area that I would certainly go in. But
mm.
others, I do know of some young people who made some significant money by speculating. So, you
Perhaps
never rule
luck.
anything out, but I think stick to what you understand would be my theory.
There's a long history behind real estate and
There is. And it's a proven wealth creation
Yeah.
asset class. So, it just involves a bit of patience and long-term thinking.
Yeah. What is your advice to younger investors trying to build lasting wealth?
Well, I think, as I said, I would start off if I was, 19, 20, which I was, buy a house to start with. Build
Yeah.
some equity within your own house. Give yourself some security of where you can live. And over time, hopefully that value will increase faster than what your income will. And you'll be able to then use that equity to invest in other real estate. I would
Mm.
I would have a higher proportion of my money, and I do today, in real estate investment than I would in any other asset class. But I understand it. I feel more comfortable in it. I think people need to be comfortable in what they're going to invest in, and also understand it to be
Yeah.
to be
Yeah,
sure in
beautiful.
creating wealth.
Yeah. So on our podcast, Marketing Made Iconic, we like to drive into what drives people, the purpose behind the passion. And I know you've spent decades in this space, still deeply involved. So I want to talk about motivation. So when we spoke initially, you mentioned a 94-year-old investor still doing deals. What do you learn from people like that?
Yeah, look, that 94-year-old investor was a very wealthy family. He headed up a wealthy family office, and I learned a lot through that discussion I had with him on his journey. And I think he succinctly put it to me that, life is a journey. You start off by, in the business world, wanting to make enough money to support your family. Once you've made enough money to support your family, it then becomes a hobby. And, in his case, he didn't play golf. He didn't have a boat. He didn't do horse racing. So business was his hobby. And
Yeah.
he enjoyed investing longer term in various asset classes. I think to a degree you do have to enjoy what you're doing, and I always said to myself that if I ever struggled to get out of bed to go to work, it's time to change. So,
Yeah.
um, you know, as human beings, we all got to work for some time. So you want to make sure you're enjoying what you're doing. Now, I think with what I do in real estate, I'm quite lucky in that it gives us a fair bit of freedom to look at opportunities in a way and obviously use the experience that we've built up. And some of that is investing in things that haven't worked, next
Yeah.
time not to do that again. So, not everything's going to be a winner. You certainly got to have some of that experience and lose a little bit of money to, that's what I say. I've got lots of experience because I've lost money over the journey. So that's when you learn the most.
Here's what not to do.
Yeah, correct. Exactly. Make
What
sure it's
does
not your whole wealth so you don't start from scratch. Just it's a little bit in each.
diversify, right?
Diversify is important, correct?
What does legacy mean to you at this point in your career?
Well, I think, I've got 3 kids. I want to make sure that my kids have got a bit of a head start. And I think most of us individuals, as you get older, you tend to want to do and provide more for your kids than perhaps you had the opportunity to have provided to. My parents gave me a lot of a real start in education, and which they didn't have as migrants
Yeah.
coming out of Italy at the time. And I value that more than easy with what they've and given us a life in Australia where they migrated. My dad migrated when he was 18 years old, couldn't speak the
Yeah.
language, etc. And started with nothing.
Yeah,
So I
wow.
think you learn a lot from people like that, and they gave us work ethic and they gave us education. I suppose what I'd like to do, my kids had the benefit of a great education and they're learning the work ethic part at the moment. And, hopefully we can leave them a little bit to make their life a little bit easier as time goes on.
Yeah,
But
yeah.
certainly they have to learn to earn it. It's not something that I think if you get something too easy, it probably, it's not the same value as if you worked hard for something.
Yeah, yeah, for sure. And finally, what gets you out of bed in the morning?
That's a good question. Look, I start off the day by going for a walk every day for about an hour. And
Oh, nice.
then I like, that does freshen up the mind a little bit, and then gets me into the office. And at different times, it's either dealing with leases that are expiring and negotiations, and or looking at new opportunities, or making decisions on whether it's a good time to sell certain things. So,
Yeah.
we have a small team of about 20 people, 14 in Perth and 6 across Australia. So, I tend to communicate particularly with everybody in the eastern states, early in the morning, and try and get everyone focused on what we need to achieve over the next 12 months. I enjoy that, so for me, it's not, doesn't feel like work. It feels like enjoying time with people around you who you like, and also trying to achieve things as time goes on.
Yeah, that's great. That's great. Angelo, thank you so much for joining me on the podcast today. Your depth of experience and valuable and grounded insights, I think, are going to be so helpful to listeners out there. And I know the audience is going to take away a lot from this conversation. For anyone who wants to learn more about Acure Asset Management or get in touch, what's the best way to find you?
You can certainly look up our website. It's www.acurean for assetmanagement.com.au, or you can call us in Perth on 08 9322 5448.
Beautiful. And to our listeners, if this episode made you think differently about how wealth is built, share it with someone who needs to hear that. And we're all about long-term thinking, smart strategy, and meaningful conversations at Marketing Made Iconic. So until next time, thanks for listening.